Brad, and your host of the No Bull Precious Metals Report. This is the one report on the internet where the goal is not just to give you an overview of what's happening, but to try to build some context around it. I try to do this without any of the usual hyperbole or sensationalism that usually accompanies a discussion of silver and gold, as we all know. Everything presented here is data-backed and run through the analytical ringer. Charts, trends, economic reports, I got it all for you. So sit back and become a better stacker, collector, investor, or enthusiast. So first up on our schedule today is the market overview as provided by FinViz's Futures Dashboard. Just as a note, I get no financial or other compensation from FinViz. I just like the product. I've used it for years. I've gone through and been a subscriber. I've used their free product, everything else. I like what they do and have no problem endorsing it. I have a link in the description. So one of the first things that we can see when we look at this report here is that the indices are mostly flat again today. So if we look at the top line on the chart, both the Dow and the S&P are riding right, effectively zero. And actually right now, pretty much all of the American indices are riding right around zero, which isn't too surprising. The larger commodities board, however, is mostly green, which is nice. There are a few bright spots, but things are mostly positive yet constrained. We're seeing everything from that bright lime green, which indicates the highest amount of gain day over day, all the way down to kind of like that sickly mucus green that we're seeing around, heating oil, sugar, feeder cattle, and sadly silver is also in that spot as well. But overall, metals are looking okay. Palladium is up today as well as copper. Palladium is pretty bright green at the plus 2.3%. Copper is up 1.3%. Both silver and gold are on the positive side of things, which is great. However, platinum is down. So overall, there is positivity in the market where it's been mostly humdrum for the last few days. But a lot of this is being driven by the reports that came out. So let's move on over there and take a look at what we've got going on. So today on the schedule, which is Wednesday, June 16th, we had building permits, housing starts, and the import price index, which was released. These were a mixed bag, but could have been a lot worse than what they were. Building permits showed a decline by about 500,000 month over month. Housing starts beat the previous month, but fell short of the analyst predictions by about 600,000. So these two together show that even in the face of the crazy market demand that we're seeing in real estate, the supply just isn't keeping pace on either improvements or on new construction. So what that kind of drives us to is expect further increases in home prices. The final report in the index battery for today, or the report battery today, was the import index. And the big thing with this is this went from a 0.8% last month, and it rose to 1.1%. All while analysts expected a 0.1% increase, or a decline rather. They kind of fumbled the ball on that one. And this means that imports got more expensive. That's pretty much what the index means. So while the equities themselves weren't actually moved that much by the release, taken together, all of these reports show that inflation is real and upon us, despite what the Fed has to say. And speaking of the Fed, we'll be hearing from them at 2 p.m. today, which should be fun. Jerome Powell is going to have a press conference after the Federal Reserve press announcement. And as many of you might know, the Open Market Committee has been meeting for the last day or so. So we're hoping to get some sort of announcement, direction, whatever's going on with that. And we'll have to see where that goes. But I expect that that's going to be something that's going to provide us with a little bit more direction to the markets, and I'll explain that as we start getting into it. But before we do, on this page as well, we can see a couple of different things I just want to briefly cover. The 10-year Treasury rate. Yesterday we were seeing that it was going down and mostly flat, but we saw that that actually closed up a little bit as of last night at a 1.5%. And then today it's trending just a little bit down at 1.49%. So that's all kind of positive, but again, it's real hard to take that take it authoritatively just because of the Fed that's going to be making the announcement later. So keep an eye on that. I'll probably run through this again tomorrow just to see where that all ended up. But the final thing is really the gold-silver ratio here. And what's important to note is that with the silver price and the gold price the way that they are, we're seeing this real happily below that 70 mark, and especially below that 68 mark that we saw previously. We're at 66.69 as of the time of recording. And the retail market, retail 1 ounce silver to retail 1 ounce gold, that is 58.51 to 1. So both of those are very favorable numbers based off of what we've seen. Pretty much anything below 70 right now is pretty decent considering where we were not that long ago. So let's turn to the markets themselves. Let's see where things are. And so the first thing that we see is that silver is a hair up from yesterday. And let me just zoom in on this quick. I will expand what is today. And current price that we're seeing is $27.92 as of recording. And the things that we're noting on silver is that we're kind of hovering, about 15 cents over where we were on the close yesterday. It's a conservative rise, but it's not horrible. And any rise is a good rise. We're currently, a few cents off of the VWAP for the 5 days. The VWAP, 5-day 27.94. So we're 2 cents off. If we apply the previous day, we're pretty significant. We're riding quite a bit above. The previous day was 27.77. So, that's actually pretty decent. We look at the intraday, and we're right in that neighborhood. So the thing that I want to point out, and especially here, is as we start going through, I'm just going to change up a couple things and throw on my handy-dandy box here, pull that off and that off so that you can kind of see. One of the things that's interesting to note is we do wind up with these levels of tests that occur, where you start seeing adherence to these to the VWAP itself, and where these lines actually start to shape up is that you see resistance and support that forms around the deviation bands as well as the VWAP, things like that at various periods, and that's one of the indications, especially if you're crafting your own, of understanding whether you have it, in the right spot or something like that, because a lot of this stuff does tend to fall right into place, and it's real easy to kind of get into this curve fitting type of mentality of looking at things and starting to identify, well, it hit here, so therefore it makes sense, or this is the way it must be because these lines touch. But it really is something that does apply over the longer term, and you can start to see it as you start to put logical basis on things, because the markets do move in predictable fashions like that. You can kind of tell what the guidance is, and that's why technical analysis does tend to work in a lot of cases, especially over short-term trades. But that is all that I have to say on that for right now. So let's move on to gold. And gold again, let me just zoom in here on this, and we can see gold has pretty much, it's also up from yesterday as well, although barely. We can see it lowered by a deviation from the 5-day. So we're really just kind of, we're right in this neighborhood right here. Um, we're right in that area. We're seeing it right on the transition. We're hovering right around that -1 mark. And we can see right now it's starting to increase just a little bit. But as we start looking at the previous day view app, I mean, who would have guessed? We hit it right there. We look at the intraday, and the intraday is riding right between where the price is hovering and where it hit from the previous day. So I mean, again, these are just kind of lines that are applied, but they have mathematical basis to them. And if you have any questions about that, refer to Monday's video. That if I can figure out how to do it, I will put a link in somewhere around here. So as we start moving on, the one thing I do want to point out, I don't want to spend a lot of time on it, but volume here is pretty interesting to me. And part of the reason for this was as I was kind of scanning through the markets, everything else, doing my normal look, I happened to notice a bit of a change that I wanted to point out, which was over the last couple days, the spikes are not gold. The spikes happen to be copper. So that's kind of an odd occurrence to me. One, copper's riding a little bit higher than normal in general, in terms of contracts traded. But generally, as I've spoken about before, is that gold is normally the spike that you see. It's that background. As we start looking at these stalagmites that are here, you can see that these are pretty much gold. And then silver normally has a pretty strong showing. But over the last couple of days, we've seen an interesting reversal, whereas copper has been the primary, gold has been secondary, and then silver is the tertiary. But the other thing that I want to point out here is this relationship between where these spikes fall and how much movement do they impart in the market. So if we look at the 26, 7, or 26,000, I'll call it. If we look around there, we can start to see which one is right here. So that spike that we had, that 26,001, 2637, I'm getting caught on that each time I say it. That we can see actually was a pretty decent volume spike for copper, but it had an effect on copper that changed its price downward by 1.37%. So I mean that was pretty significant. If we look at this other one, this 32.5 thousand or 33,000, we can see that this one was, if I can find it, somewhere around here. I'm probably just missing it, or it's buried underneath another one. So I'm going to pull these off. And that is one of the nice things about this. I was looking at the wrong one. I was looking at gold. 30.5 thousand. So we look at that. Here's this 30.5 thousand. We can see that that was a big spike, but it really didn't move it too much. It moved it 0.17, 0.17, which means that pretty much the battle between buyers and sellers was pretty intense, with really the buy side pushing the price up only slightly. So even though there was a big spike, there was pretty even supply demand, and that's something that's always nice to see. It's that whole it's the imagery of the bull and the bear kind of pulling against each other. And then finally we get to this last one, which was the copper at 26,491. and this is where that is, and kind of a mirror image of the other spike that I first started with. This one moved it positively by, eight tenths of a percent, 9 tenths of a percent, somewhere in there. So we can see that this stuff starts to move the price quite a bit. So it's something to keep in mind of where this is, and this is one of the reasons why I actually created this, was being able to see, what are the effects of these spikes in volume on price, and how much activity is there, how much demand is there, because oftentimes we see these monstrous spikes that occur and realize that, wow, okay, well, that they really don't move it too much, or something of that nature. Um, so looking at, like, for instance, this gold, 76 277, 76 277. So that was a huge spike that happened way back when, but only moved the needle by, you know one 0.15%. So again, you had lots of buys, lots of sells. They were both battling out. Eventually, the buying won. Price went up a bit, but not by that much. So it just keeps it in context. So moving on to retail, um, this is where we really want to kind of take a look at this. Um, so we see that on the first chart, our average pricing is edging out the last week's numbers, um, but on just some key items. The Philharmonics and Maples especially are a few cents higher per ounce. Generic is a penny over. ASEs are continuing to decline, and in fact, they're down by 20 cents based off of previous week on average. And I mean, when you start looking, that they're almost 30 cents as we start looking going forth to the previous 2 weeks. So this is all showing kind of an interesting distribution of how the pricing is starting to work out on the average retail as we're starting to go across. Um, so yeah, if we actually look down on this a bit further, so like down on the 1 ounce generic silver, we can see that the trend line is definitely moving down, although there is a slight kind of an upward hook that we're getting, towards the end. But we're still seeing a rather wide distance between the average and the median price, which said that there's a pretty good distribution of pricing across things, or at least that there are some definite outliers that are kind of dragging down the average a bit. And the one thing that we're seeing is that the lower pricing is going to be more extreme just because the average is staying below the median, which is really why I kind of put those two lines on this chart together so that I can see exactly how they start to move through. And you can see, without actually digging into the charts themselves and trying to look at the source data, you can get a sense for exactly where the prices are falling. If there are prices that are falling more on the higher side, and there are some extremes that are going on, the median is going to get basically where the center line is for everything. The average is going to get kind of pushed around based off of where the most extreme values are going to fall. So as we can see, the more extreme values are towards the low side, which what that means for you is, as a buyer, when you see a chart like this, if you're in kind of that average range where you're starting to look at some of the distributors and you're starting to see, that $33 mark for generic rounds or something, you can know kind of in your heart you can do better. You're going to be able to find kind of that nugget in the dirt that is the lower price or the lower end of the scale on it. So if you're around average in a situation like this, keep looking, because there are better deals out there, and especially if you find yourself on the higher side of things. The other thing I'm going to bring up is the American Silver Eagle that we're seeing. So the ASEs are also trending down, though it's not as evident on this chart just because of scale. On the generic chart, we were seeing a spread of basically about $1 between high and low. With the ASEs, obviously, we're considerably more. We're like $13, $14. So so it's harder to see kind of the trend. But again, the one thing that we can see, which is the reversal, is that the higher end of the spectrum is pulling this average up. So we've got a few very distinct outliers that are up there. Again, probably the eBay auctions and the eBay sellers, just because of the fees and everything else that goes along with it. But we're seeing that these prices are up there for, especially the high side, 51.13, which gives us that average of 41.97. However, on the bottom side, we're seeing the median price is only 39.41 with a low price of 38.37. So as we start to look at those, you're going to see more in that lower end of the range. So in in all, it might not be a bad time to purchase. Then again, I'm a fan. To me, it's never a bad time to purchase. So let's move around to gold real quick. We can see what's going on. And gold is continuing a much more obvious week-over-week decline in their average pricing for the various items. The notable exception is really that American Gold Eagle 10th, which is still in decline, but it rose last week and then is falling back down. So, I mean, across the range, we're seeing the declines. The American Gold Eagle, definite decline. You can see that. That's a pretty obvious step. The Panda is in decline. All the way across the board, we're seeing some good discounts. And again, even within the generic pricing, we can see that's kind of rolling through from beginning June 9th. We were 1980. We're now 1937. It's a pretty decent discount that's going on right now. And we can even see this, a little bit. If you've been following this channel long enough, when I get to these charts, the gold market to retail and the retail variance from spot, that you can kind of see exactly, how gold moves. And right now there's a lot of wide distance between these two. And even in the variance that we're seeing, I mean, gold wants to kind of rise up on retail. It's not really liking what the market's doing in terms of going down. So it's kind of resistant to it, and that's kind of what I'm interpreting this with. And we saw that until really first thing this morning, 8:30, when all of a sudden, they kind of moved in tandem. They all hit kind of the same adjustment point, and now they're starting to spread out just a little bit more. So it'll be interesting to watch as this comes up throughout the days. But I wonder if there's going to be some sort of a retail reversal or some sort of a retail revolution that's going to go between gold retail and gold spot. But that's something that we'll have to figure out. So in summary, right now is a good time to purchase, in my opinion. Deals can be found both on gold and silver. So it's not too bad. There's a lot of distribution in relation to the spot movements. The market is hesitant. The actual commodities market is hesitant, but ready to move. I expect as the week winds down, though, we're going to see more concise direction and adjustments, and especially that's going to be driven a lot by the Fed chairman's remarks and what the confidence levels are after that. Then again, I mean, right now it's a good time to buy, and it's always a good time to buy, in my opinion. So keep going. So that does it for this installment of the Noble Precious Metals Report. If you enjoyed it, please remember to like, share, and subscribe for updates when I release a new video, which I've been doing, every day. They're always fun, they're always informative, and you get to listen to me pontificate about the world's greatest metal. So until next time, happy stacking.